Get on the bull.
S&P 500 program trade by level 1. By level 1.
Wake up call, pal.
Level 1.
Go to work.
Welcome back to Trading with GB. Today we will talk about war from a textbook strategy and trading point of view. We will look at some logic behind the chaos, game theory, and the Greeks. For years we've talked about the US and Iran being in a game of chicken. Two players heading for a head-on collision, each waiting for the other to swerve. Recently they decided they were done swerving. In game theory terms, they recalculated the Payoff Matrix. They decided that the cost of a nuclear-capable Iran was higher than the cost of a Cold War. In game theory, this is a preemptive move. But here's the thing about game theory. Your opponent still gets a turn. Iran's retaliation, the drone swarms, the missile strikes on US bases, the functional closure of the Strait of Hormuz, is a classic tit-for-tat strategy. In a repeated game, if you don't hit back, you lose all future credibility. They aren't trying to outspend the US military. They are trying to make the cost of participation so high that the US is forced to find a new, albeit bloodier, equilibrium. Let's think of the collective view. As traders, we are playing a game of incomplete information. We don't know what's said in the situation room, but we see the bets being placed in the markets. When the Strait of Hormuz closes, you aren't just trading oil, you're trading the probability of a global energy shock, or at least how the market values it. I've often had a thought that is a little different from the usual way to think about trading. When you trade anything, gold or crude oil or an index, etc., you're not trading that instrument. You are trading the collective view of that instrument. And in fact, when you take a position, you are trading against what everyone else thinks it's valued. Your screen tells you the equilibrium. Your job, and where your balls come into play, is to know how to see it differently. It is to know when to disagree with it. Right now, oil isn't just a commodity. It's a weapon of economic attrition. It's a bet on time and a bet on the next move, or a potential deal. Then there are the safe markets like the dollar, gold, and treasuries. Again, you are trading perception. What is safe? Do we need to be in safe? Then there are also related markets. There is soybean oil and corn, for example, and then the markets that are correlated to those two. If you don't know, soy goes into diesel and corn goes into gasoline. When the passage of crude is blocked, the world doesn't just look for more oil, it looks for anything that burns. That's why your grain screen starts flashing. These markets start taking less notice of the daily fundamentals and more on the global situation. This changes the risk and opportunity bullet points. Okay, so more on risk. I think I read somewhere a long time ago that you can always tell the age of a trader by how much they talk about risk. It's probably true and probably just a smart-ass thing to say, but we move on. How do you trade this without getting blown up? You look at your Greeks, forget the news for a second and look at the math. Vega, or the war premium, this is the king of the 2026 market. Since the war started, implied volatility, IV, has gone vertical. If you're long options, you're long Vega. You're betting on more chaos. But be careful. If a ceasefire is even rumoured, you'll see vol crash that will incinerate your premium faster than any of those missiles. Gamma, or the speed. With headlines hitting 24/7, the market is gapping, not trending. If you're short options, Gamma is your assassin. A $10 gap in crude at the open means your delta accelerates instantly. This is why we're seeing whipsaws that are clearing out retail traders every single morning. Theta, or the cost of waiting. Because Vega is so high, options are incredibly expensive. You are paying a massive war tax just to own a contract. If the war enters a stalemate for even 48 hours, Theta will eat your position alive while you wait for the next explosion. You have to be mindful of these things. They are what values your premium. Now, you don't need to be sitting there with an HP calculator, but you need to understand what makes an option worth what it's worth now, and what the risks are in either direction. And there is one really important point here, the screen versus reality. I speak to a lot of people that are paper trading or trading one thing, but looking to expand into other areas like options. My best trading has been in options, so I have to say I'm all for it. But I also have to point out some realities. Well, there are many realities, but writing out this podcast script has made me think of one example where what you see on the screen or the conclusions your analysis come to are vastly different from the practicalities of trading. In other words, you want to buy or sell at X, but X does not exist. You want to stop at X, but your fill is X plus a lot. In the days leading up to the 9/11 attacks, our fund was in a FTSE index spread that was trading something like 29 at 35. That means 29 bid and 35 offered. Each point was £10. Following the attacks, that spread went 50 at 550. That's a 50 bid and a 550 offer. In money terms, that is a £5,000 spread for a one lot. If you want to know what having your guts ripped out feels like, trying being on the wrong side of that. Liquidity dried up and the market makers were having a huge laugh. No one in their right mind would hit that bid at 50 or lift the offer at 550. No one. The point? In times of extreme volatility and fast markets where the usual bid-ask spread requirements do not apply, what you want to do versus what you are able to do can be very two different things. You might argue a fair and reasonable value for that spread was 300 points, the midpoint of 50 and 550. But go try to get a fill. At that point of time, it was impossible. At the time, I also had a word for those market makers. It started with F and rhymed with mother truckers. This is the type of crap that can go down and leave someone relatively inexperienced like a deer in the headlights. Once you've seen it, you know better, of course. The lesson? You don't make decisions based on what you want to trade. You make those decisions based on what is available to trade. Also, you don't trade the news. Instead, trade the reaction to the news. Your job is to stay rational and look forward. Oh, and if you want to know if we traded at 50 or 550, we did neither. That was the poker game the makers were playing. We just went and played a different game. At the end of that month, there was still hurt, but far less than if we went along with someone else's game. One more thing. The books will tell you to keep your stops tight too. That's rubbish. That's textbook rubbish that everyone feels they have to say. Trying to keep a stop tight when you see 50 at 550. In a screen trading world, your stop might be triggered by a 300 print for a one lot. Then the next offer is, guess what? And that gap puts you in negative equity. So no tight stops. If you're going to trade, you are better of trading far less size like in the micros or a calendar spread or an option spread with close strikes. Use smaller sizes and know how the Greeks can impact your position. Know your exit, approximately at least. Know how you will exit. Is there a hedge trade that will work better? Here is another example of stops in ugly times. We were trading indices when Japan suffered the earthquake and subsequent tsunami in 2011. I was guiding a group of new prop traders, and I did not say, keep your stops tight. At the time, I said to some, get hard and get in full clip. To a couple of others, I just said, get in. We had a feel for where the market was going, and given the time of day, we correctly thought we had enough time for it to play out. That said, I was still a bit nervous to provide that advice. I mean, I was not 100% sure of where it could go. It was not my first disaster event, but it was my first earthquake while training new traders event. Sometimes in prop trading, you get in, then think about the rest. In this situation, we did just that. We got in, then spoke about risk and the what-ifs. We didn't open up a textbook and read the bit about keeping your stops tight. I think we did a decent job at adapting to what the market was capable of at that very time. Get in, let the shit play out, and then define the plan. The bottom line. Game theory. And the Greeks give you the map, but the market's liquidity, or the lack of it, is the actual terrain you have to hike. Don't let a clean-looking chart or a fair value calculation lie to you when the world is on fire. In this 2026 war, The winners won't be the ones with the best textbooks. They'll be the ones who can look at a spread without blinking, adjust their size, and trade the reality that's actually on the screen. Stay rational, watch your tail risk, and don't be the deer. That's it for this one. For more, subscribe to this podcast and check out my training site, masterclasstrader.com. Use the code trading with GB for 20% off and sign up to the newsletter as there are new things coming soon. Until next time.